You were told that saving money was the responsible choice, that if you worked hard, avoided debt, and put money aside, you would be safe. But history shows the opposite, because in every major financial crisis, the people who saved were the ones who lost purchasing power, while the system itself survived, adapted, and grew stronger. This didn't happen because savers were careless, and it didn't happen because they made bad decisions, but because the financial system was never designed to protect savings in the first place. It was designed to protect institutions, debt, and control. And once you understand why saving fails again and again across decades and crises, once you see the mechanism clearly, you can never unsee it, because what looks like personal responsibility is actually participation in a system that quietly works against you. Let me show you how this works by taking you back to 1933, to the middle of the Great Depression, when approximately 9,000 banks had failed across the United States in just 3 years, and millions of Americans who had saved responsibly, who had done everything they were told to do, watched their life savings simply vanish because the banks they trusted had gambled with deposits, had made speculative loans, had operated under a system that allowed them to lend out far more money than they actually held in reserve. And when confidence broke and depositors tried to withdraw their funds, the banks couldn't honor the withdrawals because the money wasn't there. It had been lent into existence and now it was gone. And the savers, the people who had trusted the system, bore the entire loss. Now here's what's critical to understand about what happened next, because the government's response reveals how the system actually prioritizes interests, and the response wasn't to make depositors whole, wasn't to punish the banks that had destroyed savings, wasn't to fundamentally restructure a system that had proven catastrophically flawed. Instead, the government closed all banks simultaneously through what they called a bank holiday, preventing anyone from accessing their money. And when banks reopened days later, some deposits had vanished entirely. Some were converted to bank stock that became worthless. And the government simultaneously made it illegal for Americans to own gold, forcing them to surrender their gold coins and bars to the government at $20.67 per ounce, only to have the government immediately revalue gold to $35 per ounce, which meant that people who had saved in the hardest, most historically reliable form of money had roughly 40% of their wealth confiscated through legal decree. And this happened not to protect savers, but to reflate the economy, to give the government and banks room to expand credit again, to restart a system that had just destroyed millions of people's life savings. And what did savers learn? From this experience, what lesson did the system teach them? And the lesson was clear. Your savings exist to serve the system's needs, not your security. And when the system faces stress, when institutions need to be preserved, when confidence needs to be restored, savings are the resource that gets sacrificed, because savings represent stored value, concentrated purchasing power, and in a crisis that purchasing power can be redirected, devalued, or confiscated to solve problems that savers didn't create. And this pattern hasn't changed. It's just become more sophisticated, more hidden behind technical language and policy justifications that obscure what's actually happening. If what you're hearing is connecting dots you were never shown before, subscribe now, because this series only makes sense when you see the full sequence, and the next layer will make today's story feel even more personal. Fast forward to the 1970s, to a different kind of crisis, not a banking collapse but an inflation crisis. And this crisis teaches us something else about how saving fails, because the 1970s were a period when Americans who had saved in dollars, who had accumulated what they thought was wealth in bank accounts and bonds, watched that wealth lose more than 60% of its purchasing power over the course of a decade. And this wasn't because of some external attack or natural disaster. This was the direct result of policy decisions made by the government and the Federal Reserve, decisions to finance government spending through monetary expansion, to disconnect the dollar from gold in 1971, to print money to cover obligations that tax revenues couldn't support. And the people who suffered most were the people who had saved, because their dollars bought less and less with each passing year, while people who had borrowed, who had taken on debt, saw the real value of their obligations shrink. And this reveals something fundamental about how the modern financial system operates, which is that it's designed to favor debtors over creditors, borrowers over savers, because the government itself is the largest debtor, and inflation reduces the government's real debt burden while destroying the real value of savings. But the destruction wasn't random. It followed a clear mechanism, And understanding this mechanism is critical because it's still operating today. And the mechanism works like this. When the government spends more than it collects in taxes, it needs to borrow the difference, and it borrows by issuing bonds. And these bonds need buyers, and if there aren't enough buyers at the interest rates the government wants to pay, the Federal Reserve steps in and creates money to purchase the bonds. And this newly created money enters the financial system. It expands the money supply, and when the money supply grows faster than the production of real goods and services, the result is inflation, which means each dollar buys less and your savings, denominated in dollars, lose purchasing power. And this isn't a side effect. This isn't an unfortunate accident. This is how the system manages debt that can't be repaid through normal means, by inflating it away, by devaluing the currency, by making savings worth less so that debt becomes easier to service. And here's where most people miss the critical insight, because they think of inflation as something that happens to prices, as things costing more, but what's actually happening is that money is becoming worth less. And this distinction matters because it reveals who benefits and who loses. And the people who benefit are those with fixed debt, particularly the government, because they borrowed yesterday's dollars and they're repaying with today's cheaper dollars, while the people who lose are those who saved yesterday's dollars, because those dollars buy less today. And this transfer of value from savers to debtors is systematic, predictable, and built into how modern fiat currency systems operate. So if saving gets punished in the exact moments people need security most, why are we still taught that saving alone is the safest plan? Now let me take you to 2008, to the financial crisis that should have taught everyone exactly how this system works. Because what happened in 2008 was that banks and financial institutions made catastrophically bad bets. They leveraged themselves to extraordinary levels. They created complex financial instruments that even they didn't fully understand. And when the housing market collapsed and these bets went bad, the entire global financial system teetered on the edge of complete breakdown. And faced with this crisis, governments and central banks around the world made a choice. They could have let the institutions that took excessive risks fail, could have allowed markets to clear, could have forced losses onto the people who made bad decisions. But instead they chose to bail out the institutions using taxpayer money and newly created currency. And this choice reveals the system's core priority, which is institutional preservation regardless of the cost to individuals. The Federal Reserve created trillions of dollars through quantitative easing, purchased toxic assets from banks at inflated prices, held interest rates at zero for years. And all of this had a predictable effect. It saved the banks. It prevented institutional collapse. It preserved the system's structure. But it devastated savers because if you were a retiree in 2008 who had planned to live on interest from bonds and savings accounts, your income disappeared. It simply vanished when interest rates dropped to zero and you faced a terrible choice. Either accept a drastically reduced standard of living or take on more risk by buying stocks and other assets at prices that had been inflated by the very policies that destroyed your safe income. And many retirees chose risk, and some prospered, but many others lost principal during subsequent corrections, and none of this was necessary. It was a policy choice, a decision to protect institutions at the expense of savers, and it happened not because policymakers were evil, but because the system is designed to prioritize its own survival over individual property rights. And this brings us to a realization that changes everything once you see it clearly, and the realization is this: saving money fails not because individual savers make mistakes, not because they lack discipline or education, but because the system treats savings as a resource to be tapped when institutions need support, as purchasing power to be diluted when governments need to manage debt, as stored value to be redirected through inflation and policy manipulation. And once you see the system, you can't unsee it. You can't go back to believing that responsible saving will automatically lead to security, because the evidence is overwhelming that in every crisis, in every period of stress, savings get sacrificed to preserve institutional stability. And this pattern is so consistent, so clearly documented across decades and countries, that it can't be dismissed as coincidence or bad luck. Now, if you're following this series, if you're watching these videos as they release, you're building an understanding that most people will never develop, because most people hear these stories as isolated events, as historical curiosities that don't connect to their current situation. But you're seeing the pattern, the recurring cycle of print, inflate, in debt, control, and you're understanding that this cycle doesn't end. It adapts, it continues, and the next iteration is already being built. And the people who understand this early, who subscribe and follow as each layer gets revealed, they're the ones who have time to think through implications, to position themselves differently, to make choices that protect rather than expose their wealth. While people who wait until the pattern becomes obvious to everyone find that their options have narrowed, that the mechanisms of control have solidified, that understanding comes too late to matter. So let me show you how this pattern continues in the present, because the same mechanisms that destroyed savings in 1933 and the 1970s and 2008 are operating right now, just with different technical names and policy justifications, because the United States government currently carries debt exceeding $35 trillion, which is roughly 125% of annual economic output, and this debt grows by approximately $2 trillion every year, and the interest payments on this debt now consume an enormous portion of the federal budget, approaching levels that become mathematically impossible to sustain through normal tax revenue, and everyone involved in managing this system knows these numbers, knows the trajectory, knows that at some point the debt becomes unpayable through conventional means, and that point creates the same choice that's been faced repeatedly throughout monetary history: default explicitly by refusing to pay, which destroys confidence and crashes the system, or default implicitly by inflating the currency, by devaluing savings, by making the debt easier to service in nominal terms while destroying its real burden through currency debasement. And which option do you think they'll choose, based on everything history teaches us, based on every previous crisis, based on how the system has responded every single time it's faced this choice? Because they always choose inflation, they always choose to preserve institutions by devaluing savings. They always transfer the cost from those who created the problem to those who trusted the system. And this means that if you have substantial savings denominated in dollars, if your retirement plan depends on those savings maintaining their purchasing power, you're making a bet that this time will be different, that somehow the pattern will break, that the people managing the system will choose your interests over institutional preservation, and that bet contradicts every lesson history has tried to teach us. But here's what makes this moment particularly important, because we're not just facing another iteration of the same old cycle, we're facing a technological transformation that could make everything we've discussed seem almost quaint by comparison, because the system that slowly devalued savings through inflation, that gradually transferred wealth through policy manipulation, that operated with some friction, some delay, some space for people to react and adapt, that system is being replaced by something faster, more comprehensive, more inescapable, and that's what the next video reveals. The mechanism that's being built right now to complete the transformation from a system where savings slowly lose value to a system where money itself becomes programmable, controllable, subject to restrictions and conditions that make current policy tools seem almost gentle. And this is why understanding needs to happen in sequence, why each video builds on the previous one, because you can't understand the digital control grid being constructed without first understanding why the current system already works against savers, and you can't see why that digital grid is inevitable without understanding the debt trap that makes it necessary from the system's perspective. And people who try to jump into the middle of this series without building the foundation miss critical connections. They see isolated facts without understanding the pattern, and pattern recognition is what separates understanding from confusion. So here's what I need you to do, and I'm being direct because this matters. Subscribe to this channel right now. Turn on notifications because the next video reveals how digital currency completes what we've been discussing, how central bank digital currencies give institutions control over money that makes inflation seem like a blunt instrument, how programmable money can be restricted by geography, by time, by category, by political compliance, and how this transformation is already happening in multiple countries, while most Americans remain completely unaware. And the people who understand this before implementation are the people who still have options, while the people who wait until the system has been built and activated find themselves trapped in a framework that's nearly impossible to escape. And I don't want that to be you. But beyond subscribing, beyond watching the next video, I want you to think about something, and I want you to share your thoughts in the comments, because this question doesn't have a simple answer, and different people will see it differently based on their own situations and values. And the question is this: if saving money consistently fails across every crisis because the system is designed to sacrifice savers to preserve institutions, and if this pattern is so clearly documented that it can't be dismissed as paranoia or conspiracy thinking, then what does responsible financial planning actually look like? Because the advice we're all given, to save steadily, to build a nest egg, to trust in compound interest and long-term thinking, all of that assumes a system that rewards saving, but we live in a system that penalizes it. So how do you reconcile the gap between the advice and the reality, between what you're told to do and what actually happens to people who follow that advice? And more fundamentally, at what point does participation in a system designed to expropriate your savings become a choice rather than an obligation? And what alternatives even exist when the system has become so comprehensive, so integrated into every aspect of economic life that opting out seems impossible? And yet people throughout history have found ways to preserve wealth across currency collapses and systemic breakdowns. So what can we learn from them? And what does that look like in the context of the United States in the 21st century? Think about that. Discuss it in the comments, because your insights matter, your experiences matter. And this conversation is just beginning. And the more people who understand what's actually happening, the more collective awareness we build, the harder it becomes for the system to operate in the shadows. And while awareness alone won't change the fundamental incentives built into the architecture of debt-based fiat currency, it does change what's possible individually, what choices you make, what risks you avoid, and that matters more than most people realize. So join this conversation, share your perspective, and make sure you're subscribed, because the next layer of this story reveals something that will reframe everything we've discussed today, and missing it means remaining in the dark while others continue learning. And that's exactly what the system depends on: your ignorance, your trust, your compliance. So don't give them that advantage. Stay informed, stay aware, and I'll see you in the next one.